The sector moving higher, overcoming any investor concerns about global growth in the face of tariffs. Well, joining us now is closely followed industrials analyst Stephen Tusa of JPMorgan. Stephen, it's great to have you back on the show. And let's start right there. What is powering industrials and why?
Yeah, thanks for having me. It's been an interesting year, pretty volatile one, but we're kind of back to where we started at the beginning of the year with the optimism around growth, except what's changed is during Liberation Day and that entire period, estimates got reduced actually by 2-3%. So expectations were kind of artificially reset. The stocks are back to where they are, which means that they're definitely more expensive. The valuations are at all-time highs, 23 times forward earnings, which is a pretty big number. But going forward into earnings, you're going to see probably some beats and raises on the back of tariff costs coming down, pricing remaining strong, and foreign exchange is probably a 1 to 2% tailwind. So while the multiples are high, it's not a bad setup as far as earnings beats are concerned.
Okay. What do you like within the space? And I ask that knowing that a lot of these are global manufacturers. You just mentioned tariff costs, potentially coming down, but these are the types of names that can be hit by those types of supply chain dynamics on the one hand. On the other, you have a number of secular growth stories playing out in the sector.
Yeah, sure. We still like the growth names, even though they're at our price targets today, based on data center, utility demand, which is, kind of linked. That would be Eaton and Vertiv. Those are the two we've been recommending for a while now. And the data center story is still, I think we talked, maybe a year ago, ferocious. This investment cycle is nothing like we've ever seen as far as the intensity of it, and the pipelines continue to expand, and that's going to require, as you said, more power. So we still like that theme for sure. But with these valuations where they are, we do have another side of the barbell. And in the last few months, we've been talking about some idiosyncratic margin stories. JCI is certainly one of those. That stock is now above our price target. So we're kind of turning the dial a little bit here in the last several weeks to a bit more value and defensive names. One of those is 3M, which we like into the second half of the year, and another one would be Fortive, which just spun off a business that is trading at close to a 6% cash yield, and that's really uncommon right now versus the group at a 4% cash yield. So just turning the dial a little bit more towards defense, given that optimism is pretty widespread right now.
Stephen, how exposed is the overall sector to a hiccup, a kind of valley of doubt in the timing of the AI story, maybe reminiscent of what we saw happen with the internet 20, 25 years ago?
It's definitely vulnerable from a sentiment perspective, and I think what's interesting about this is that I kind of caught the tail of that in the beginning of my career, and there was a lot of belief in that bubble until it bursts. I would say that this time around, there is a dramatic amount of skepticism. It seems like every couple months somebody wants to call this a bubble and call it the end of the story. And I just don't think that a long-tailed infrastructure cycle like this, which is, it takes 18 to 24 months to build one of these facilities now, these big 1 gigawatt facilities. It's very hard to overbuild in a period of 1 to 2 years, and we're kind of in year 2 of this. So I'm pretty confident that this is going to have a longer tail to it, and typically bubbles don't burst when people are watching for that. So I think the skepticism is great for the stock, and it's given for the stocks, and it's given us plenty of opportunities in the last 12 months to double down on this call.